I'm going to share some slides here. As always, if you're a KCM member, you can go into the KCM member area, download all of these slides, use them for videos, use them for whatever you want to do to get the message out there. Let this information be the tools and the resources that you use to be the educator in the market. Because a lot of people are asking, you've seen the memes or the questions on Facebook, will homes be worth more or less in the next 6 months? And a lot of people asking that. But let's start here. I'm going to start this morning with what I just mentioned, pending home sales. It's a graphic developed by our research team, really does a good job of laying out pending home sales. The top giving you a sort of a historical perspective of pending home sales. The bottom giving you pending home sales broken down by region. And certainly they are down. And you can see down in every region there at the bottom. But if we look at the top, as NAR measures pending home sales, 100 would be a healthy level. Came in most recently in February, 104.9. So not an unhealthy level, but certainly lower than the last couple of years, ahead of 2019. But no doubt with that being down, there have been a lot of headlines saying this is an ominous sign for the housing market. This is a sign of things to come. I'm going to make the case today that pending home sales are down because we don't have the inventory to sell, not because there's a lack of demand in the market. And certainly put your comments here on Facebook and let me know if you're seeing the same thing where you're at, and I'll watch for that. So many good folks, so many good to see everybody joining right now, still watching that. Glad to have you on. So let's talk about this. Sales are down. Why is that? I'm going to sort of break this down in just a minute. NAR has just released their traffic maps, but I'm going to make the case that's not because we don't have demand. First place I'll start right here is the buyer traffic index from NAR. Most recent information you see across the country, we have strong buyer demand. Many folks still try to hop in off the fence as rates rise. They want to say, I want to get in before rates get any higher, and we're certainly seeing that happen. A couple of states where there's stable buyer demand, but across the country, strong buyer demand. Not this very strong number that we see in that almost that deeper blue/purple, but strong all over the country. Now, what does that mean for sellers? Well, almost the exact opposite. There is very week to week seller demand. You see up here in the Midwest above Nebraska and Wyoming, very weak, almost looks like there's nothing there in the country. We need more sellers in the market. So pending home sales being down is a reflection of the lack of available inventory for those that want to buy homes today. I think the bottom line right now is we will not reach the market potential in real estate this year without more homes coming on the market. There is a frenzy still in the market. If you look at John Burns Consulting, they measure offers per listing and where they're at. This is very interesting. And it goes back to July of last year. And what you see is, if you go back to July of last year, 59%, almost 60% of the resale homes in this country received multiple offers. And then as we went into the fall, that number started to ratchet down, bottomed out in November at 47%. And as we've entered the new year, that's ratcheted back up to the most recent number in February. About 2/3 of the resale homes in this country received multiple offers, higher than where we were July of last year and certainly through the fall. And so we're seeing this urgency and this this frenzy in the market alive and well, certainly not indicative of, pending home sales being down and there being less demand in the market. And all of this, this demand with short supply pushes prices higher. This is a look at January price appreciation as measured by FHFA, CoreLogic, and Case-Shiller. In all of them, they're measuring different aspects of the market, but 18.2, 19.1, 19.2, a lot of appreciation in residential real estate. And many experts were saying coming into the new year, we'll see price appreciation start to moderate. And we've seen, if anything, we've seen it pick up steam. Last year, if you followed the deep dive as we started to go into the end of the year, we talked about price appreciation having plateaued or peaked. And we're seeing it through November, December, and now January pick up steam as more and more people say we want to go out and buy a home. This is very interesting as we look at prices right now. And this is the information we need to get in people's hands about prices across the country. I'll kind of close our pricing piece before I get into the future with this quote right here from Case-Shiller. Last fall, we observed that home prices, although continuing to rise sharply, had begun to decelerate. Even that modest deceleration was on pause in January. The 19.2 year-over-year change for January, the fourth largest reading in our 35-year history. So no doubt there's a lot of appreciation in real estate right now. A lot of that is due to the lack of supply on the market and many people hopping off of the fence to get into the market as rates rise. So let's sort of turn the corner for a minute and say, what's ahead? I mentioned as we started, many people putting quotes or things on Facebook saying, what do you think home prices are going to do in the next 6 months? Do you think homes will be worth more? Do you think homes will be worth less? What is your opinion and comments and everything there in between? I'm going to give you what experts are saying. This is largely coming from the Home Price Expectation Survey. The Home Price Expectation Survey is a measure of 100 economists, investors, market experts that say, where do they believe the home prices in this country are going? And so this comes out every quarter. We bring all that to you so that you can be the educated agent. You can bring this to your clients and say, hey, this is what experts are saying about home prices. So first one, cumulative home price appreciation by 2026. If you gather all the optimists, they say 46.5% appreciation. All of the panelists together, 26.8%. The pessimists, 10.3% appreciation. Now you can determine where you fit in that. Are you an optimist or are you a pessimist about price appreciation? But even if we take the pessimist point of view, 10% appreciation. No one calling right now for depreciation in the market. That's important. If we start to look at this by year, here's what the home price expectation says about home price performance by year. This year, 9% appreciation, about 4.75% appreciation next year, and then leveling off into what I'm going to call a more normal rate of appreciation, 3.6, 3.4, 3.5% appreciation. We've talked about forecasts in just a minute. I'm going to show you the latest forecast for price appreciation in residential real estate in this country. But if anything, we've said, somewhere between 8 and 10%, forecasters are up leveling their forecast right now for prices in this country, and a lot of frenzy in the market that all the pricing forecasts will be determined by supply and demand and what's happening there. But all of this, if you take it on an average price home, here's what's at stake. Right now, buying a home today and looking forward to 2027, about $96,000 in home equity growth between here and 2027. This is a potential growth in household wealth over the next 5 years based solely on home equity. If you purchased about a $360,000 home, that's an average price home in this country. If you're in a market that's a multiple of that, you'd want to multiply that number and say, okay, for whatever your market size is, this is what the potential growth is based on what the Home Price Expectation Survey is saying. Why is this important? Many people asking, are these prices sustainable? Are prices going to go down? And I think this gives you an expert's perspective on what's out there and what experts are saying about home prices. I'll wrap up with one slide here. Home price forecast for this year. The 7 forecasters that we measure here, anyone from 3% at Zelman, 9.6% CoreLogic, the average 6.7%. I think we're going to see that ratcheted up as we go through the next couple of months. As forecasters have sort of a bias to the upside right now, meaning they're looking at forecasts saying, I think it's going to be a little bit more. I think we're going to see a little bit more appreciation, and we're certainly seeing that with the lack of inventory. I'm going to pause here for a second. Jess, do we have questions that folks are asking?
Yeah, I saw one question come through from Tego, who asked, at what point do we hit a cap on what people can afford? Is there any way to measure that?
Yeah, I think it's a great question. I think we're going to see that in the coming months, but affordability is a relative thing. There's two things that are important about that question. First is affordable housing. The second is housing affordability. And I've drawn that out and we've talked about it on the deep dive before. Housing affordability refers to what the dollar will buy, and affordable housing typically refers to homes on the bottom end of any market. We know we need more homes on the lower end of the market. Affordability, though, of what the dollar can buy is still strong. And if you want to send me a message, if you want to send me a message, David at Keeping Current Matters, I can send you all of our updated information on that. When I say it's strong, homes are still affordable today. But I think as interest rates rise, as prices rise, then affordability becomes a question, no doubt. But we're in a time right now where homes are less affordable, but they're not unaffordable. But I think that question right there is one on many people's minds.
Awesome. Thank you, Dave. And we did have a couple more questions come through while you were giving that explanation. Scott said, David, great info. Obviously, the data is very bullish for real estate. Playing devil's advocate, if you were trying to show data to support a bursting bubble, is there anything out there to show that the bubble will burst?
Yeah, that's a good question. I think that's a question that's on a lot of people's minds. The challenge, I think, right now, and we've written several blogs about this that you can go back and grab, is you have to look at market dynamics relative to a bursting bubble. And here's what I would point to. First of all, equity positions in homes today are much greater than what we saw in the housing crisis. The other position I would say is we're in a very low inventory time and have been for the last couple of years in this country. So if you were going to support a bubble, you'd have to support a scenario where there was a constriction in the amount of equity in homes and inventory shot up. And depending on a local market, you may see that where you're at. I don't know, but I can't see that nationally right now. Anything that comes on the market, whether it be a foreclosure, whether it be a resale, whether it be new construction, is snapped up pretty quick. Do I believe the frenzy will last? No, I don't, but I have a hard time pointing to what would stop it right now. That's my honest answer there.
Great, thank you for that, Dave. And one more that came through from Drew here, who asked, do you think that if rates go north of 5%, will we see a slowdown in demand?
Do I think rates will go north of 5%? And if so, is there a slowdown in demand? I think it's likely rates will be headed north of 5%. What experts have said is that we shouldn't expect to see the rapid increase in rates like we've seen in the first 90 days of this year. We basically went from about 3% to 4 3/4 on the average 30-year fixed. We're not going to see that quick of a rise, but I think we could expect to be at 5, knocking on the door of 5. Time will tell based on inflation, based on what the Fed does, based on the instability in Ukraine with the Russia situation. But I think we could. I don't know that that's going to squelch demand. It will take some people off the sidelines. The word that I would use in that scenario is moderate the market. I think it will be one of the contributing factors to removing some of the frenzy from the market. But I don't know that it's going to take a tremendous amount of folks out of the market.
Awesome. Thank you for that, Dave. Last thing I just wanted to mention, if you're interested in downloading the slides for today, if you're a member, you'll be able to visit the deep dive archive of your member area to watch today's replay and download the slides. If you're not a member, you can visit trykcm.com. And all of the sources that we use for the slides are also going to be available there for you.
Yeah, I want to respond to one other question I saw in there. Jason asked this, that I appreciate all the facts. Is there a way we can find the specific facts you quote? I need that for my followers. So if you're a KCM member, I'm going to show you something real quick. So let me go to this quote right here, for example. I can't show it to you right here in the view, but in the notes of the slide, there is a link to the source of that information. So if you take the slide, you go into the notes, there will be a hyperlink to an article, to a report where we pulled this information from. That's a great question. We get asked a lot, but that's in the notes section, Jason, there for that question. I think that's it. Jess, thank you for the questions. Thank everybody for being a part of the deep dive this morning. We start every Monday this way, so we'll see you back next Monday on the deep dive. Take care.